You're watching the program that identifies market trends, provides insightful analysis, and reliable research. Key elements to help you profit from the pros. Profit from the Pros is brought to you by Zacks Investment Research. Learn more by visiting them online at zacks.com. Welcome to Profit from the Pros. I'm Terry Ruffalo. Well, stocks had a mixed week as investors kept their eye on earnings forecasts and economic reports. Second quarter corporate reports have largely yielded fairly strong earnings and outlooks. Economic news, well, that's a mixed picture at best. Probably the most telling of these economic reports came Friday morning, as second quarter GDP data showed the economy lost momentum, rising at a 2.4% annualized rate, well below the 4.4% average increase over the last 6 months. It was also reported this week that durable goods orders fell for a second straight month in June. The Fed talked about signs the economy is running out of steam in its Beige Book report. But the one bright spot this week was Monday's report of a bigger than expected jump in new home sales in June after a plunge in May. Let's bring Steve Reitmeister in here now to kind of give his assessment on a couple of key areas and key issues out there. You know, not counting the final trading day of July, people have been hearing about volatility for the past 30 days, and they assume that that means markets going this way, but actually July shaping up to be one of the strongest months in the stock market this year, with the major averages north of 6%.
Right. Well, they talk about the volatility index as being the fear index, okay? And all volatility means is that things are spiking around. It doesn't mean anything about direction, okay? It just means that we're kind of seesawing back and forth, and it's hard to see what the market's going to do the next day. That's all volatility means. But here again, to your average investor, that is a scary thing because they want to have some kind of predictability in the future. But yes, after 2.5 months of downward action, the market resurrected very nicely in July, and I think it's the best one month performance in the past 12 months, which is pretty stellar given how good a lot of the months were in late 2009. So. Right. So very strong on that count.
You looking for that momentum to spill over into the third quarter?
I don't think so. I think what we saw is that thanks probably to a bit to corporate earnings. Okay, it was like, you know what, things aren't that bad, folks. Let's get rid of some of that over pessimism that was there. So we resurrected back up. So it's not that we have momentum; it's just we stopped the bleeding, I believe, on the market.
You mentioned a moment ago the average investor. Okay. Let's turn to you now for a little weekend wisdom on how not to be the average investor, but rather how to dare to be a great investor. What characteristics does one need to go ahead and do that?
Yeah, I think what happens is people get far too caught up in what the crowd is doing or where the market is going. And what we find is when we take a look at who are some of the greatest investors of all time, we take a look at folks like Warren Buffett, we take a look at folks like John Templeton, who their fame rose up in some of the toughest times. So, for example, John Templeton, he borrowed money during the 1930s to buy over 100 stocks, that were all trading for about $1. Almost half of these companies were in bankruptcy proceedings at the time, but he just said, this is overdone, things can't be this bad. So John Templeton, now Sir John Templeton, is one of the most famous investors of all time, because what he showed is he showed a contrarian viewpoint, the ability to just stand up and say, you know what, the rest of the investing world is wrong, I see us rebounding from this, I'm going to profit from that. So a contrarian standpoint. Then you have patience, and I think folks like Warren Buffett are a great example of having patience. So he did very similar things to what Templeton did, but he did it during the 1970s when the market had some tumbling down. And that's when he came up with great statements like, be fearful when other people are greedy, and be greedy when other people are fearful. So the ability to be contrarian and to be patient, to make your picks and wait for them to play out. These guys have made a lot more money than you and I combined, and I think there's something to be learned from that.
Interesting thoughts. Also, independent thinking goes along with that contrarian
absolutely.
Viewpoint, and emotional stability. I found that to be kind of interesting.
Yeah, I mean, the fact is, here, to say, you know what, the crowd is running away from these things. That is what is creating the opportunity. So, looking at the horizon, there's some truth out there. Stocks can't grow to the moon and they can't fall off the planet either. Okay, and so to know though when people are running away from stocks, that is always one of the best times to get in there.
Give me a quick final grade on earnings season while we're talking here.
Yeah, I would put that in the range of a B+. Okay, so it's not going to put you on the honor roll. Okay, but it's a very solid reading, and what it's saying is second quarter was very good. There was some positive guidance going forward, and here again, what I was trying to say earlier is providing some stability to the market to stop some of that downdraft that we were seeing in May and June.
A couple of quick stock sectors that you like right now?
Because I think we're going to kind of muddle through for a while, I think some sectors that are a little bit more on the stable side of things. I happen to like telecom. I'm going to give a telecom pick later in the show.
Okay.
And just anything that really has a high dividend yield, I would consider right now.
Okay, we'll look forward to that. We'll look forward to having you stick around with us because there's more still ahead. Here is your Bull and Bear Stock of the Week. Two stocks, one an outperform, the other an underperform, make up our Bull and Bear of the Week. Shiraz, me, and our research director here once again to chat with us about them and tell us what makes each what they are. Starting with Hospira Corporation. Ticker symbols traded on the New York, HSP is the ticker. What makes this a bull?
This is a $10 billion market cap. Generic drug maker, also makes medical devices. It's in the generic injectables segment of the generic pharmaceuticals, and this is a very nice niche of market in which the company has established quite a good position. They were spun out from Abbott Laboratories and are located here in Lake Forest, Illinois. Three reasons why I have them as the bull. Number one, they have a very good pipeline of drugs in the coming few quarters, which are expected to drive top and bottom line. Secondly, one of their key competitors in a core medical device market that they compete in has fallen on hard times. And third, the margin outlook for the company looks good. Getting quickly back to the drug pipeline issue that I brought up, they have been doing pretty good in bringing out these new generic drugs. And later this year and early next year, there are about 3 drugs that are scheduled to come, and that'll be driving the company's top and bottom line. Baxter International is one of their competitors, and one of their IV pumps has been malfunctioning and has had problems. The FDA came out hard on them and asked them to either replace them or recall them. There are about 200,000 of those out there in the market. Hospira has a competing product. We believe that Hospira has an opportunity to gain market share there. On the margin front, the company had instituted a number of measures, cost cutting, shutting down factories, and others, and the benefits of those are coming out right now in earnings and margin improvement. So overall, Hospira looks to be a good pick at this stage.
Okay, Unisys, UIS, the ticker symbol, this week's bear. What makes it a sell?
Believe it or not, this is the one of the oldest tech companies, but they have fallen really on hard times. They have 2 segments. The core largest revenue earnings contributor is this IT services segment where they provide the outsourcing and systems integration and a whole bunch of consulting type of services. And about 15% of revenue comes from this hardware business. So the core IT services business is the one in which they are having a lot of problems. And the core issue there is their lack of differentiation, which can make them stand out from some of their peers. They had solid earnings earlier this week, but those earnings gain and earnings beat was driven by the smaller hardware segment. That's more lumpy. We don't expect that to be repeatable. In the core services business, the revenue stream is constantly coming down. So 2008 numbers were higher than 2009. 2009 was higher than 2008. 10, and similarly going forward. So this core bread and butter business is eroding top line strength.
Got to leave it there. Stock screening next. Screen of the Week, an overview of a timely strategy aimed at helping you become a more effective stock screener. Stocks making new highs. That's what we're screening for this week with top stock screener Kevin Matris, who joins me here once again. Now, with all the volatility in the market lately, all the up and down of the market and negativism out there, kind of hard to remember that there are still stocks out there making new highs, isn't it?
Yeah, very true. And today's screen is going to focus in on just those kinds of stocks, buying stocks making new 52-week highs. What's interesting, though, is that there's a lot of people out there who are reluctant to buy stocks making new 52-week highs. But if you're one of those guys, you should stop and ask yourself why that is.
Yeah, why is that? That's a valid question.
I suppose it's because people may feel like they have missed it, or that now the stock potentially has more room to fall. But if a stock is making a new 52-week high, that's a good thing, in the same way that a stock making a new 52-week low would be considered a bad thing. And I'm pretty sure that a guy who dislikes buying stocks making new 52-week highs would be tickled to death if a stock he was already in was making a new 52-week high. And why wouldn't he be? Because statistics have shown that stocks making new highs have a tendency of making even higher highs. These are the stocks that you want to be in. So it almost seems kind of silly to be afraid of stocks making new 52-week highs only because you haven't yet purchased it.
Yeah, that makes sense. I mean, if you were in and glad to be in, then, why not?
Right. It does make a lot of sense. And if you think about it, there's a lot of stocks that are making new 52-week highs year after year after year. And, I mean, can you imagine all of the money you'd be leaving on the table if you were afraid of buying a stock just because it made a new high? So it's a different way of looking at it, and maybe a better way of looking at stocks making new highs.
All right, let's get to those parameters.
All right, screen we're looking at today is focusing in on, of course, stocks making new 52-week highs. What we're doing here is we want to find stocks that are trading within 5% of the 52-week high. So they either hit a new high or are trading very, very close to it.
All right.
Next one is a price-to-sales ratio of less than or equals to 1. A price-to-sales ratio of less than 1 means you're paying less than $1 for every $1 of sales the company makes. And I have found that by focusing in on this valuation metric, oftentimes you can find companies that are still considered undervalued even though they're continuing to charge higher. Also, too, I want to see these stocks moving higher on increased volume. So the parameter is the current average 20-day volume is greater than the previous week's average 20-day volume. Seeing it move higher on increased volume means increased demand, and that bodes well for the future.
All right, and stocks that came through?
Yeah, there was a bunch of stocks. Here is a diverse list. You have Bemis Company, DTE Energy, Hawaiian Electric Industries, NiSource, and Sealed Air Corp. All of these companies look great on a valuation metric based on the price of sales, and they are all charging higher.
Yeah, that is diverse, and you do the screen often enough. Is the list always that diverse?
Usually it is, because you're going to see companies from all different industries really, showing great sponsorship. Always get a diverse list.
Okay, and do you own any of these?
None of those.
All right. Well, Kevin joins us at the Roundtable coming up next. You won't want to miss it. He's just going to move down a seat or two, and then he'll be back with us to kick around what's going on in the markets and in the economy this week. Stay with us. If you have a question or a comment about our show, send it to us at mailbag@zacks.com. We'd like to hear from you. That address, once again, is mailbag@zacks.com. Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. Well, second quarter GDP data is out, as we said at the beginning of the program. Our panelists now are going to give you their quick read on the data. Editor-at-large Steve Reitmeister, stock strategist Bill Wilton joins us this time around at the Roundtable, and that market maven himself, technician Kevin Matris. You never know what he's going to say next, but we'll start with you this time around.
Okay.
2.4% in the second quarter as far as a growth rate is concerned. The growth is definitely slowing, no way around around that. Is this growth too slow? Is this a number that we need to be concerned about now?
Not for me. I mean, the expectation was 2.5%. That's pretty close. And here, as we know, there are going to be revisions over time, and so it could go a little bit higher, a little bit lower. So it's definitely in line. And let me just simplify this. After you have a asset bubble like we had, and you go through a time of deleveraging, to expect a off-the-charts robust growth economy is just ridiculous. We should be very happy with modest growth. 2.5% is probably at the high side of what we'll be seeing over the next few years, and maybe as low as 1 to 1.5% growth. But growth nonetheless. Okay, so I think that this was actually what should have been expected and fairly good news.
You buy that, Bill? Any growth is good growth?
Yeah, I have to agree with you there. And you did mention those revisions, and we actually saw Q1 revised upward in this same report. The other thing that I liked about it is that one of the big things that kind of weighed on the actual number was that we had a huge surge in imports. So we're seeing a lot of corporate spending. You know, that's a good sign of the underlying strength of at least, you know, the companies are more confident in their outlook. So, you know, given that, you know, the actual number's a little bit low, but there was plenty to take away on the positive side there. And, you know, myself, I'm a little bit more bearish than most, and I found this to be a pretty satisfying report.
Kevin M., what do you think? A lot of people say that this number, 2.4%, approaches the wall of worry. Are you in that camp?
Well, I'll agree with Bill. It was satisfying. What's interesting is that the headline was kind of a disappointment. It was 2.4, but it was only a very, very slight miss. What I found to be most fascinating, though, is Bill had touched on it. They came out and they increased Q1 by a full point. I mean, that's a 37% upward revision. And what I don't understand is, how can the government miss 37% of economic activity? My first reaction when I heard this number was, if that, up until now, unreported economic activity was added to Q2, as opposed to being added to the back end of Q1, we'd be having a significantly different conversation right now. Everybody would be talking about how fast the economy is growing. So I found that to be pretty fascinating. The takeaway for me is that I don't think the Bulls or the Bears got an upper hand with today's number. I think it just is what it is. Now everybody will start wringing their hands over Q3.
So, Steve, does this cause you to have some concern maybe about business investment taking a little bit of a dive here in the next quarter? Especially if the consumer doesn't start picking up their spending?
You know, taking a look, as Bill had pointed out here, the idea that there was a lot of imports, which may have slowed GDP, but it's a sign of demand. Okay, it's a sign that the corporations had demand. If corporations have demand, that continues. Then somewhere down the road, they have to start hiring again. Okay, and it may not be as robust as we might like. Okay, but as they begin to hire, then unemployment rate goes down. There's more income in consumers' hands, and that should improve the consumer picture. Okay, so rolling forward, I see pieces that might be beneficial for the economy as a whole. But that now plays back to Kevin's point, is that, okay, now we're done talking about second quarter, let's talk about third quarter and beyond. Right. And so now there's going to be great focus on the upcoming economic reports, I think in particular the unemployment report. That has to start improving soon.
Okay. I asked you earlier in the show for a grade on earnings season. You gave it to us. What was that again?
A B+.
B+. Bill, what, if you had to put a grade, final grade on this earnings season as it draws down here, what would it be?
I'd have to go with about a B. You know, I got to agree with that there. You know, the one thing about this earnings season, you know, as the sentiment is kind of neutral right now, depending on who you ask. You can really find positives or negatives to confirm your opinion. So if you really want to be bearish, there's plenty of bad news in these earnings reports. If you really want to be bullish, you can find plenty of good news out there.
Kevin, grade.
I'm not going to give it a grade. I'm going to give it a pass or a fail. I'll say pass, but here's two statistics that were very interesting. 83% of the S&P 500 companies that have so far reported have either met or beat on earnings, and 58% have either met or beat on sales. Now, I'd like to see the sales component beat a little bit better, so I'd like to see that thing jack up a little bit, but I think all in all, it was a very encouraging earnings season thus far.
All right, time for top stock pick of the week, Steve.
Okay, my top stock pick is an ETF once again, and I'm going with IXP, which is a global telecom ETF. as I've been trying to state here, I think we're going to kind of have a muddle-through economy of modest growth. And so things that perhaps provide a little bit of dividend and have very stable business models will do well. You can't beat telecom for that. This ETF has an average dividend yield of 4.3%. So I love that. And then you get the little bit of growth from developing markets and their growth of mobile phones.
Bill?
I'm going to go with Alette, ALE. It's a Midwestern power company, kind of like the ETF that Steve chose. It's got a nice stable dividend, 4.7%. They've just got a healthy operation. One thing that I liked in particular was they actually went ahead and raised their dividend in early 2008, or pardon me, 2009, when things were, looking the bleakest. So that's just a sign of good management, and if you're looking for stability, it's a great option.
Yeah, that's one you don't hear about often, too. First I had heard of it, Kevin.
CSX Corp, ticker CSX. They are in the transportation and rail industry. They provide railroad transportation, other intermodal services. They've got fantastic double-digit growth rates. They have below industry average valuations. And these guys have already reported. They reported about 2 weeks ago, but they were one of the companies that posted a positive surprise, up 10% on EPS. And they also posted a positive sales surprise of 2%. Looks good.
Using big words now, intermodal.
I
about
know,
that
I have
one?
no idea what he's talking about, but
Circle back on that later.
he's got a word of the day calendar.
Real quick, Steve,
Yeah.
corporate outlooks. Are they telling you anything about earnings going into the second half here?
Kevin tried to point out about the sales numbers. 58% met or exceeded their sales numbers. Another number I saw was that I think it's like 7.5% sales growth, which is actually very good because you can get big earnings on that. So that's what I like.
Okay. Thank you for joining us, and we'll look forward to seeing you next week on Profit from the Pros.